If you bought into the memory trade anywhere near the top Micron above $1,000, SanDisk near its peak, DRAM at $80 or higher, and you are watching the pullback right now wondering what happened and whether you should hold, add, or get out, this video is specifically for you. We are going to do the complete honest analysis. What caused the sell-off, whether the underlying investment thesis has changed, what the real risks are on both the upside and downside from here, and what the right mental framework is for retail investors who are sitting on losses in memory right now. Quick disclaimer before anything else, nothing in this video is financial, investment, or tax advice. I am not a financial advisor, everything here is purely educational. Please always do your own research and consult a qualified professional before making any investment decisions. Let's start with what actually caused the pullback, because the explanation matters more than the price action itself. The memory trade attracted an enormous amount of leverage, not just from retail investors using margin accounts in the United States, but specifically from South Korean retail investors, where hundreds of thousands of margin accounts were funding exposure to SK Hynix, Samsung, and the broader memory trade. When you have that many leveraged participants in a trade, a specific and predictable dynamic takes hold. The stocks go up dramatically, and we are talking about the kind of appreciation that generates enormous excitement, with Micron, SanDisk, and SK Hynix all posting extraordinary year-on-year returns. That excitement attracts more momentum buyers. Every retail investor who wants to make the momentum trade piles in. And then the buying pressure naturally comes off because eventually everyone who wanted to be in is already in. The stock stops going up. People who are paying interest on margin accounts watch the stock go sideways and start watching other things move. The new retail attention shifts elsewhere. The stocks drift lower. And then you get forced selling hundreds of thousands of margin calls in South Korea alone, which means accounts being liquidated, which means more selling pressure, which means more margin calls, which creates a cycle of selling that can take a healthy stock down 20 to 30%, even when nothing about the underlying business has changed. That is primarily what happened here. SanDisk pulled back approximately 32% from its highs. Micron pulled back approximately 19%. These were not driven by earnings misses. They were not driven by a collapse in HBM demand. They were driven by the mechanical process of a highly leveraged retail trade unwinding margin calls, liquidations, profit-taking from investors who were already up enormous amounts and decided to rotate elsewhere, and daily leveraged ETFs that become forced sellers on every down day and forced buyers on every up day, creating the kind of violent back-to-back 5% and 10% swings in both directions that you simply do not see in less crowded trades. The question that actually matters, the one that determines whether this pullback is something to ignore, buy into, or use as an exit, is not why the price went down, but whether the fundamental investment thesis is intact. And on that question, the data is clear. The fundamentals of the memory trade have not just held up through this pullback, they have continued to improve. Earnings reports from memory companies have consistently blown away analyst expectations, and not by small amounts. Analysts were projecting revenue estimates that turned out to be approximately 30% too low for a single quarter. When professional analysts with access to management teams and industry data are off by that margin in a single reporting period, it tells you something important about how fast and how unexpectedly the demand environment is moving. Every major hyperscaler, Apple, Amazon, Microsoft, Google, Meta, has confirmed on earnings calls that memory is a primary bottleneck in their AI buildout. The CEOs of these companies are not saying they have enough memory and are comfortable. They are saying they need more, that they are constrained by memory availability, and that they will pay whatever is required to secure it. The demand drivers that initially created the memory trade thesis are not just still present, they are expanding. The core argument was always that AI training and inference require enormous amounts of high-bandwidth memory, that only 3 companies manufacture HBM at commercial scale, that those companies were already sold out, and that demand would grow faster than supply could expand. None of those elements have changed, but the demand picture has broadened beyond AI training into areas that many investors were not originally thinking about. AI agents, autonomous software systems that take multi-step actions on behalf of users, require not just GPU compute, but significant CPU and memory resources for the orchestration and context management that makes agentic AI work. The ratio of memory required per AI workload is increasing as AI applications become more sophisticated. Ring cameras and smart home devices are generating more data than they ever have. Every digitalization trend is additive to memory demand. The addressable market is not contracting, it is expanding faster than the original thesis anticipated. And the supply side remains constrained in a structural way. Micron is building enormous new fabrication facilities in Boise, Idaho, and in Singapore. Taiwan Semiconductor is building new fabs in Arizona. These construction timelines are measured in years, not months. The capital investment decisions being made today reflect an industry consensus that demand will outstrip supply for an extended period, and companies do not commit to multi-billion-dollar fab construction on a whim. The committed capex is one of the strongest possible signals that the industry's view of the demand trajectory is not deteriorating. Now let's address the Chinese memory question directly, because it came up as the first negative catalyst for the memory trade when Apple indicated it was exploring Chinese memory suppliers, specifically from CXMT Changxin Memory Technologies, which is essentially the Micron of China. The concern is legitimate in its framing. If Chinese memory chips are approximately 90% as capable as the leading American and Korean products and can be made available at dramatically lower cost, hyperscalers might shift purchases toward Chinese suppliers for cost-sensitive applications, reducing Micron's and SK Hynix's addressable market. The Toyota Corolla versus Mercedes-Benz analogy is useful here. At some point both get you from A to B, and if the cost differential is large enough, the premium product loses market share. The counterargument is structural rather than dismissive. China operates an essentially closed technology market domestically while trying to sell into open global markets. Amazon, Google, and Facebook cannot operate in China. Chinese tech companies do not face market competition at home because the government eliminates it. That dynamic produces companies that are accustomed to operating as de facto monopolies without the competitive pressure that drives true innovation. The track record of Chinese tech companies competing globally with Western equivalents outside of markets where the Chinese government has specifically intervened to advantage them is not strong. Returns in Chinese tech over the past 15 years have been genuinely poor for investors. More specifically for the memory question, the data centers being built in the United States, Europe, and the rest of the non-China Western world are not going to source their highest performance HBM from Chinese suppliers given the combination of geopolitical risk, export control uncertainty, and the straightforward fact that for truly cutting-edge AI workloads, the ones that actually require the best available HBM3E products, Chinese memory is not competitive. Chinese memory will likely capture market share in consumer electronics and mid-range applications, particularly in emerging markets like Latin America and Africa where cost sensitivity is higher. That is a real competitive pressure on the commodity memory side of the business. It is not the same as a threat to the high-margin, high-performance HBM business that is driving Micron's most extraordinary recent growth. The SK Hynix accessibility question deserves its own mention, because it is a source of genuine frustration for investors who want exposure to what is arguably the most technically advanced HBM manufacturer. The American depositary receipts for SK Hynix trade in the US at approximately a 33% premium to the underlying Korean shares. That premium exists because of a one-way conversion mechanism. You can convert US ADR shares into Korean shares, but you cannot convert Korean shares into US ADR shares. The practical result is that US investors buying SK Hynix ADRs are paying roughly a third more than the intrinsic value of the underlying Korean equity. That is a significant and largely unjustifiable premium that makes Micron, which does not carry any equivalent premium, a more straightforward expression of the US accessible memory thesis. If you want memory exposure that you can buy cleanly without paying a substantial premium for the privilege, Micron is the most defensible choice from a valuation standpoint. Now let's talk about the DRAM ETF specifically, because there are structural considerations about how DRAM achieves its holdings that investors deserve to understand clearly. DRAM uses total return swaps to gain exposure to its top holdings. The reason is regulatory ETF rules require a certain level of diversification, and swaps allow the fund to claim exposure to one security while technically holding a different one, skirting the concentration limits that would otherwise apply. The result is that investors get the memory exposure they want, but through a structure that has two specific costs that are not fully transparent. First, swap costs are not disclosed in the same way that regular fund expenses are. You genuinely do not know exactly what you are paying for the swap exposure, and those costs can be substantial and variable. Second, swaps can create capital gains tax efficiency problems within the ETF structure, potentially generating unexpected tax events for investors in taxable accounts. Neither of these makes DRAM fraudulent or necessarily a bad vehicle for gaining memory exposure, but they are factors that investors should understand explicitly before deciding how much of their portfolio to commit. The alternative that avoids swap exposure entirely is the disk ETF, which provides pure-play semiconductor and memory exposure without any swap structure. For investors who want to ensure their memory exposure does not carry hidden swap costs or potential tax efficiency degradation, DISC is worth examining as an alternative. For investors who want to express the memory thesis without any ETF wrapper complexity, The direct approach owning Micron and potentially SanDisk directly gives you clean, transparent exposure to the companies actually driving the performance without the additional structural layer. The specific case for preferring Micron over the Korean alternatives comes back to the ADR premium issue and a straightforward conviction principle. If you believe the American company produces the best product in a category, and the evidence for Micron's HBM quality is strong, there is no reason to accept both inferior technology and geopolitical risk by buying a foreign competitor. The diversification principle does not mean diversifying into lower quality alternatives for its own sake. Sometimes the best company is the one you already own, and the appropriate response to wanting more exposure is to size that position more aggressively rather than diluting into inferior substitutes. On the question of how much allocation makes sense, 10% in a diversified growth portfolio is already meaningfully overweight relative to the memory sector's representation in broad market indices. In the S&P 500, memory represents a fraction of a percent. In the Nasdaq 100, it is somewhat higher but still modest. A 10% allocation to memory is a deliberate, high-conviction thematic bet that acknowledges the potential for extraordinary returns alongside the potential for extraordinary volatility. Anyone who thinks 10% memory is a conservative position is misreading the risk profile. Anyone who thinks it is reckless given the demand thesis needs to explain why 4 to 5 times the standard index weighting is reckless when the earnings growth is 200 to 300% annually and the PE ratio is still in single digits. The mental framework for investors who bought near the top and are currently sitting on losses is worth addressing directly, because this is where emotional decision-making causes the most damage. The first question to ask is whether you bought with margin. If you are leveraged on memory positions, the math of a continued sell-off is genuinely dangerous in a way that unleveraged positions are not. A 30% decline in an unleveraged position is uncomfortable. A 30% decline in a position where you put up 50% of the capital as margin can wipe out your entire equity in that position and potentially trigger losses that cascade into other holdings. Memory stocks are volatile enough, betas of 4 to 6 in recent periods, that leveraged exposure creates tail risk that most retail investors are not equipped to manage. If you are leveraged, the honest advice is to examine your total risk exposure and consider whether reducing leverage even at a loss puts you in a more sustainable position than holding through potential further drawdown. If you are not leveraged and bought on conviction, the framework is different. The relevant questions are whether the fundamental thesis has changed and whether your allocation is still within the range you can genuinely hold through continued volatility without being forced to sell at the bottom. The fundamentals, as established, have not deteriorated. If anything, they have improved. Revenue growth is accelerating. Earnings are beating estimates dramatically. The demand outlook from hyperscalers remains unambiguous. The PE ratios, even after meaningful appreciation from the levels at which the thesis was first widely articulated, remain low relative to the growth rates. A company growing earnings at 200 to 300% annually with a single-digit PE is empirically unusual and unlikely to stay at that valuation permanently. Risk scenario that would genuinely change the thesis is specific and identifiable. If hyperscalers announced meaningful cuts to their capital expenditure on data centers, citing poor returns on AI infrastructure investment, that would trigger a reduction in memory orders and a replay of the cyclical downturns that memory stocks experienced in 2022 and earlier cycles. In those scenarios, memory stocks have historically seen declines of 70% or more from their peaks. That risk is real and should not be minimized. But as of now, hyperscaler capex is not being cut, it is being increased. The announced capital expenditure for AI infrastructure from the major cloud providers for 2026 exceeds $700 billion. Until that number starts coming down, or until earnings calls start delivering guidance that suggests the data center ROIs are not materializing, the fundamental bear case for memory does not have the evidence to support it. The longer-term demand picture extends beyond the current AI training and inference cycle. Robotics, autonomous vehicles, the continued expansion of consumer IoT, the ongoing digitalization of every industry, each of these is additive to memory demand over a multi-year horizon. AI itself needs enormous amounts of data to function well, and that data needs to be stored, accessed, and moved at speeds that require ever larger amounts of high-performance memory. The infrastructure being built today for AI workloads is not a temporary experiment, it is a structural shift in how computing works, and it requires persistent, growing investment in memory that the three companies capable of manufacturing it at commercial scale are positioned to supply. The honest summary is this: the memory trade is still intact. The pullback was driven primarily by leverage unwinding, margin calls, and retail momentum rotation, not by fundamental deterioration. The earnings keep coming in strong. The demand narrative keeps being confirmed by hyperscaler management teams. The supply remains constrained. The PE ratios remain low relative to growth rates. The biggest structural risks are real Chinese competition on lower-end applications, potential future hyperscaler capex cuts, the cyclicality that memory stocks have historically exhibited, but none of them are materializing in the current data. Investors who are holding without leverage and size their positions within the range they can genuinely tolerate should have no particular reason to sell based on what has happened. Investors who want to add at current prices can point to genuinely improving fundamentals and lower valuations than existed at the recent highs. Investors who are leveraged and uncomfortable should examine their total exposure honestly and make the decisions that let them stay in the game for the multi-year period that the thesis actually requires. The best days of memory stocks may not be the last 12 months. The thesis is for the next 3 to 5 years. Be there for the full period or do not start. At Dividend Desk, we cover every corner of the investment landscape honestly, including the volatile, high-conviction thematic trades that require more than a price chart to evaluate properly. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community link in the description where we track developments like this in real time. This is Dividend Desk. We will see you in the next one.